Okay, let's take a quick look at what would happen if there's an increase in inflation expectations. What would happen to the supply and demand for loanable funds, and then what does that mean for the interest rate? So the idea here is all of a sudden people expect inflation to increase, right? People in the economy generally expect inflation to increase. So we have our supply for loanable funds, we have our demand for loanable funds, we have our interest, this axis is interest rate, so the price of funds, if you will, and then this is quantity demanded. Right, so if everyone all of a sudden expects, and you can think about what you would do if you expect inflation to increase, right? Would you supply more or less loanable funds? Now remember, when you supply loanable funds, you are buying a bond, right? You are putting you're buying some security, so you might buy a CD or so forth. So the idea here is, well, if it should become natural to you that buying a bond, inflation is the enemy of bonds, right? So if I buy a bond for 4%, and then inflation goes to 6%, well, I'm losing 2% in real terms every year, right? So the last thing I want to do is buy a bond if I expect inflation to increase. So in other words, the supply of loanable funds would if people expected inflation to increase would drop fairly drastically. So the supply of loanable funds here, I'll just use S1 and S2, right? The supply of loanable funds would be reduced at the quantity supplied at every interest rate is going to be reduced. Now, conversely, what would happen to the demand for loanable funds? Well, if I'm a business and I expect prices to go up, well, if I need some equipment, I want to buy it now. And remember, inflation is just general prices go up. So I might be a farmer. Now I expect tractor prices to go up. Then I'm going to buy I want to buy the tractor immediately before prices go up. And to do so, I'm willing to borrow. Also, I know that. If I don't want to lend money when before inflation, I certainly would like to borrow, because again, if I borrow at 4% and inflation goes to 6%, well, in real terms, I'm paying less. So the idea here is people would absolutely want to demand. So in other words, this could be households. I'm going to say I'm going to buy a car before prices go up. I'll buy a house before prices go up. So households are going to demand auto loans. They're going to demand mortgage loans. Businesses are going to issue debt. Again, demand funds. If I want an auto loan or if I want a household, that's a demand for funds. If I'm a business, I want to buy my equipment now. So again, that's a demand for funds. So the demand at all interest rates, the demand for funds increases. I'll put D1, D2. So what's happened is we've gone from an equilibrium interest rate, I sub 1, to a new equilibrium interest rate, I sub 2. So what's happened here is if people in the economy start to expect inflation, they expect inflation to increase, they're going to reduce the supply, the supply of loanable funds that they offer, while simultaneously they're going to increase the demand for loanable funds. That is going to push the interest rate up. I always have to mention this. Again, we're talking about like a general interest rate here, so I'm talking about 5-year rates, 10-year rates, 15, 20-year, up to 30-year interest rates. The very short end of the curve is controlled by the Fed. So when you hear the Fed raising or lowering interest rates, note that has nothing to do with what's going on here. What you saw when we just recently had inflation get say a little bit out of control is interest rates along the curve, 5, 10, 15-year, went up and the prices went down. So you saw mortgage rates going up into 8% and so forth. So this is how the market reacts to an increase in inflation expectations and how that rise in interest rates happen. So if market participants expect an increase in inflation, then we should see interest rates rise immediately. Have a great day.